Hello and welcome to AE Accounting Tutorials. We are continuing our series on IAS 23 borrowing costs. This is the part 5 and the final part of this standard. And I want us to take two different comprehensive practice questions and try to solve to enhance our deep understanding on this particular standard. So if you are new to this channel, I will encourage you to subscribe to this channel, turn on your notification bell because we have so many things to learn together on this channel. So let's quickly go through the question and see how we can solve this question. But then take note that if you are able to understand these two different comprehensive practice questions, I bet you'll be able to solve most of the borrowing cost questions. So you take your time and listen very carefully as I take you through these two questions. So with regards to the first question, that is on 1st January 2022, AE Limited borrowed $6 million for a term of 1 year, exclusively to finance the construction of a new piece of production equipment. The interest rate on the loan is 6% and is payable on maturity of the loan. The construction commenced on 1st February 2022, but no construction took place between 1st March 2022 and 30th April 2022 due to the employees taking industrial actions. The asset was available for use on 30th November 2022, having a construction cost of $6 million. Required. What is the carrying amount of the production equipment in AE Limited Statement of Financial Position as at 31st December 2022, and the borrowing cost that will be recognized in the statement of profit or loss? This is two-in-one question. We are being required to calculate two different things. First, we are being asked to calculate the carrying value or the carrying amount of the production equipment that will be recognized in the statement of financial position. Take note that this simply means we have to calculate the borrowing cost eligible for capitalization and add it to the cost of the production equipment and recognize it in the statement of financial position. And the second part is also asking us to calculate the amount of borrowing cost that will be recognized in the statement of profit or loss. That is the expenditure aspect. Is that okay? So this is the two different requirements. So to begin solving borrowing cost question, there are certain key things that you have to take note. First, you have to consider the various borrowing costs available in the question. In our case here, we have only one borrowing cost, that is the interest. Is that okay? And then you also have to consider the amount borrowed. The amount borrowed here is $6 million. After considering the amount borrowed, you have to also consider when the loan is being borrowed, when they commence the production of the equipment. You also consider, is there any period where they suspend construction of the qualifying asset, and you also consider the period in which the asset is completed for its intended use or sale. So these are the basic things you have to consider. Now we've established that the interest is 6%. We've also established that there is that is $6 million of an amount being borrowed. Is that okay? Now take note that the loan was borrowed on 1st January 2022, but construction actually begins on 1st February 2022. And also take note that there is a portion in this question that clarifies that from 1st March 2022 to 30th April 2022, there is an extended period in which active development of this production equipment is interrupted. That is when the employees took industrial action. So within that period, the construction of the equipment was suspended for a while. Is that okay? This simply means that within these two periods, we don't have to capitalize borrowing costs in relation to these 2 months. Is that okay? And they also made us aware that the asset or the production equipment becomes available on 30th November 2022. It means this is the period in which the asset is being completed. So it means we have to cease capitalization after this particular date, that is 30th November 2022. So this is what we have to do. So to begin with the solution, we have to consider the name of the company, that is AE Limited. Okay, we will bring our currency sign, dollars. From this particular question, the first borrowing cost is the interest. That is the only borrowing cost. So we look at the interest as borrowing cost. Interest. And the interest rate is 6%. So we apply the 6% on the amount borrowed. And the amount borrowed is $6 million. $6 million. One thing you have to take note is that the interest is always per annum. Okay, so interest are charged per annum. Is that okay? But we have to consider when we should capitalize borrowing cost. Is that okay? Here we are looking at the first requirement, that is the amount or the carrying value of the production equipment that will be recognized in the statement of financial position. That is what we want to look at. So we have to first of all determine the borrowing cost eligible for capitalization. Then we add it to the cost of the production equipment to get the carrying value or the carrying amount of the production equipment. So first of all, let's look at the interest component that is eligible for capitalization. Take note that this loan is borrowed for the entire 1 year, that is 12 months. So we can have first month, second month, 3, 4, 5, 6, 7, 8, 9. Sorry, 9, 10, 11, 12. 12 different months. But take note that in first January or in the period of the first month, there was no construction of the qualifying asset. Construction of the production equipment commenced on 1st February. So this we can't capitalize borrowing costs here. And one thing you also have to take note that there was an extended period in which active development was interrupted. That is the period of March and then April. So within these 2 months, activities necessary to prepare the qualifying asset for its intended use or sale are not in progress. Because they are not in progress, there was an active interruption of active development. We don't have to capitalize borrowing costs in this very 2 months. And the asset was also completed in November 30th. So in December, there was no construction of the qualifying assets. We have to cease capitalization from there. So we will not capitalize borrowing costs in these 4 different months. Is this clear from the question? So this simply means that we are only capitalizing borrowing costs for the 8 months. That is 1, 2, 3, 4, 5, 6, 7, 8 different months. Is that okay? So this means that the borrowing cost eligible for capitalization for 2022 is for only 8 months. So when we multiply the 6% by the 6 million, we will get $360,000. Is that okay? We multiply it by the 8 months out of the entire 12 months. Is that okay? And this will give us an amount of $240,000. Is that okay? Very good. So this means that for 2022, the borrowing cost eligible for capitalization is only $240,000. But take note that for the entire period, it happens to be $360,000. So that is how we calculate the borrowing cost eligible for capitalization for 2022. Now let's consider how to calculate the carrying amount of the production equipment. So let's look at the carrying amount. That is the carrying amount of the production equipment. There was a construction cost that has been given to us. So the construction cost is 6 million. Construction cost. And that is 6 million. Then we have to add the borrowing cost eligible for capitalization to determine the carrying value. So we talk of borrowing cost. Borrowing cost to be capitalized happens to be 240,000. So $240,000. So the carrying value of the production equipment will be $6,240,000. So this is the carrying amount of the production equipment that will be recognized in the statement of financial position. I told you capitalization has to do with adding the borrowing costs eligible for capitalization to the cost of the qualifying asset. That is what we've done. Is that okay? So we are done with the first part of this question. So let's look at the second part of this requirement. That is borrowing costs to be recognized in the statements of profit or loss. Okay, this is very simple. One thing I want you to understand is that the entire borrowing cost for the period happens to be 36,000. That is for the entire year. But the borrowing cost eligible for capitalization is 8 months. Okay, and we've determined that, and it's 240,000. So to know the borrowing cost that is not eligible for capitalization is subtracting the month for capitalization from the entire month, that is 8. This will give us 4 months. Okay, so to determine the borrowing cost to be recognized in the statement of profit or loss, what we have to do is to multiply the interest rate, that is 6%, on that of the 6 million. But this time we are multiplying it by 4 out of 12, okay, in dollars. So this will give us 360,000 for the entire period, but we only want for 12 months, for 4 months. This 4 months simply means that during this period, the activities necessary to construct or prepare the production equipment for its intended use or sale are not in progress. Before you'll be able to capitalize a borrowing cost, 3 different criteria must be met. We said the first criteria is the expenditure of the qualifying asset must be incurred, the borrowing cost must be incurred, and all activities necessary to prepare the qualifying asset for its intended use or sale must be in progress. But within these 4 months, the activities necessary to prepare the production equipment are not in progress. It means we can't capitalize. If we can't capitalize borrowing costs, we have to recognize it as an expense in the statement of profit or loss. That is why we are taking the 4 months as expense of the borrowing cost. So this will also give us $120,000. Is that okay? So this 120,000, it is the expenditure component of the borrowing cost that will be recognized in the statement of profit or loss. So let's look at the second question and see how we can solve it as well. The second question has to do with on 1st January 2020, ABC Limited began construction of a toll bridge. The construction is expected to take 3.5 years. It is being financed by issuing bond for $7 million at 12% per annum. The bonds were issued at the beginning of the construction. The cost of issuing the bonds are 1.5%. The project is also partly funded by the issue of share capital with a 14% cost of capital. ABC Limited has opted to capitalize borrowing costs under IAS 23. The company's year-end is December. How much must be capitalized in the first year? So our requirement is to calculate the borrowing costs eligible for capitalization for 2020. Is that okay? So before we begin to look at the solution, there are certain key things we have to take note. The construction actually begins on 1st January 2020. This simply means that the activities necessary to prepare this qualifying asset for its intended use was in progress throughout the year 2022. And then the issued or the bond issued happens to be $7 million of an interest rate of 12%. There was also issuing cost of 1.5%, and there is also 14% cost of capital. So this question may be technical if you don't know the component of borrowing cost. So it is for us to differentiate between the components of borrowing cost and those items that are not components of borrowing cost. Is that okay? So let's begin with the solution. So that is ABC Limited very good. So in dollars. So the first borrowing cost we have to look at is the interest. But before we begin to look at the borrowing cost, take note that cost of capital is an exclusion to IAS 23. Cost of capital is not part of the component of borrowing cost. So if you attempt to add the cost of capital component as part of the borrowing cost, the whole calculation will be wrong. So what I want you to understand is that you have to know the various exclusion of borrowing costs. Basically, I gave you 4. Is that okay? So you can go and watch the part 2 of this video to know the exclusion of borrowing costs, so that if they comes into the question, you don't include them in calculating borrowing costs. And I'll give you the 4 exclusion along the line. So the first thing we need to talk about is the interest. So interest. And the interest rate is 12% on the loan amount, that is 7 million, or the bond issued, and this will give us $840,000. Take note that this 12% interest is for the entire year, so we are not going to calculate maybe a portion of the months to determine the borrowing cost eligible for capitalization, because throughout the 12 months the activities necessary to construct the qualifying assets are in progress. So if it happens that maybe construction begins in March or maybe February, or there is an extended period where active development was interrupted, then we need to take those portions out. But in this case, the construction of the qualifying asset took place during the entire period of the loan, that is the 12 months, that is the 1 year. So we only apply the 12% on the bond issued to determine the borrowing cost for the period. After this, the second borrowing cost in this question is the ancillary cost. The ancillary cost happens to be the issuing cost. So we have issuing cost, and the issuing cost happens to be 1.5%. One thing I want you to also take note is that the construction is expected to take 3.5 years to complete, but then we are only calculating borrowing cost for the first year, the very first year. Okay, so take note that 3.5 years are expected to take to complete the qualifying assets, but we are only calculating for the first year, and ancillary costs are for the entire period of the construction of the qualifying assets. So we have to amortize the ancillary cost, which is the issuance cost or the issue cost for a year. So to do that, we have to multiply the issuing cost rate by the loan amount, which is 7 million. Okay, then we divide it by the term of the loan or the duration of the construction of the qualifying assets, that is 3.5 years. 3.5 years. And when you punch this into your calculator, you arrive at an amount of $30,000. This may look somehow complex to you, and I can break this down to you. We know that for the construction to take 3.5 years to complete, it means that this particular qualifying asset will take, 3.5 years is equivalent to 42 months. Is that okay? So you can do it this way. If 3.5 years is equivalent to 42 months, then we can say that when we multiply this amount or the rate by the 7 million, the amount that we will get, we can amortize it based on a month. So we can do this, that is 1.5% multiplied by 7 million. And this will give us $105,000. And this $105,000 is the ancillary cost, which is the issuing cost. And this is for the entire duration of the construction of the qualifying asset. And the duration is 3.5 years, that is 42 months. So we can divide this or amortize it by the 42 months to arrive at $2,500. This is per month. $2,500 is per month. So to determine the issuance cost or the issuing cost for 1 year, we multiply this by 12. And this will give us 30,000. So either you go by the straightforward way to arrive at the 30,000, or you go by this way. Okay, so we arrive at 30,000. So we add the issuance cost to the interest. Okay, and this will give us an amount of 870,000. Very good. So this 870,000 will be the borrowing costs. To be capitalized. That is for 2020, only 2020. Someone may ask, why didn't we add the 14% cost of capital in the calculation of the borrowing cost eligible for capitalization? I told you earlier that the cost of capital is an exclusion to IAS 23. It is not part of IAS 23. In the part 2 of this video, I gave you 4 different exclusions. The first one has to do with the imputed cost of capital. The second one has to do with short-term inventories. Okay, short-term inventory means those inventories that are produced within a short period of time. But we've learned that before we can calculate borrowing costs of an asset, that asset must be a qualifying asset, and the qualifying asset takes a substantial period of time for it to get ready for its intended use or sale. So if an inventory which is an asset is being completed within a very short period of time, then that cannot be the finance cost in relation to that particular asset cannot be capitalized. So short-term inventory is also another exclusion to borrowing cost. And we have assets or qualifying assets that are measured at fair value. So if a qualifying asset is also measured at a fair value under IAS 41 agriculture, such qualifying asset cannot also be classified as part of borrowing cost, but rather it is an exclusion. And we've also learned a preference shares or preferred capital. So this brings us to the final part of the IAS 23. In our subsequent video, we may look at another standard or